care about the move from 1900 to 2100. I don't care about it at all. I came into the racket in the 70s, and the gold price moved from $35 to $950. I made a bunch of money in the decade of the 2000s when gold moved from 256 to 1900. I could care less about $100 moves. Either way, it doesn't matter to me at all. I think that there's a chance, even unfortunately a good chance, that gold goes to $6,000 or $7,000.
A recent survey by the World Gold Council found that 43% of investors believe that gold prices will rise in the next 12 months. This is the highest level of investor optimism towards gold since 2011. RickRule is a well-known figure in the financial industry, serving as the president and CEO of Rule Investment Media, LLC. In this video, RickRule envisions substantial price fluctuations in the safe haven asset, gold, with projections of reaching up to $7,000 per ounce. Gold rallied 7.3% last month as demand for safe haven assets has increased. We believe gold is likely to continue to benefit if Middle East tensions increase. Gold has more reasons to rise in the wake of the Federal Reserve's decision in November to stand pat on interest rates, helping to make a price climb back above $2,000 an ounce a real possibility in the last few weeks of the year. Meanwhile, Rick questions the enthusiasm for 2.5% gold price fluctuations, highlighting its potential for significant returns, including a possible quantum move in gold's price. Gold's inability to convincingly break above $2,000 an ounce is creating some cautious sentiment in the marketplace, with some analysts saying that prices might need to consolidate in the near term before the precious metal takes a run at its all-time highs. Now, we present the clips of RickRule's insights from his recent interview with SOAR Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I think that there's a chance, even unfortunately a good chance, that gold goes to $6,000 or $7,000.
It's kind of clean.
So I have sort of 2% of my net worth in bullion. I don't want gold to go to $6,000 or $7,000 because that would harm the rest of my portfolio. But the idea that somebody cares about a move from $1,925 to $2,010, why would you care about that? You care about a quantum move, and gold has the capacity for a quantum move. There are a lot of reasons why that quantum move might occur, but it's certainly no guarantee that it will. It's impossible for me to understand why people are excited about a 2.5% move in a commodity that you should own for a quadruple. It's important for people here to understand, because they have lives and don't, the difference between investing and speculating. Many people go in the exhibit hall and look at the juniors and they say they are investing and juniors. No, they're not. They're not investing, they're speculating. It's important for investors to know, too, that if they're investing or speculating in the context of them believing that there's going to be a systemic bull market in either precious metals or natural resources, that they should concentrate most of their efforts on investing, not speculating. If you have an energy bull market, Exxon will triple. Okay, I mean, you'll get a penny stock move out of a real stock. If we get a copper bull market, a real one, you don't have to buy amalgamated Moose Pasture copper. You will get a move in Lundin Mining that's a four-bagger. You'll get a move in BHP or Rio Tinto that's a double or triple. So if people are allocating capital in anticipation of a bull market, they need to invest in real companies that have the materials that they think will accelerate in price. You speculate because you think affairs within that company are going to generate alpha to the resource market. That's a very different, much more difficult, much riskier, but much more rewarding endeavor. So that's what I want to talk about. I want to talk to people about how and why they invest and how and why they speculate. Many people, most people, believe that they're investing in the penny dreadfuls, which is a poor use of English and a poorer use of capital.
RickRule points out a notable contrast between the CPI's 3.2% reported inflation and his belief that his personal purchasing power is diminishing significantly faster. The annual inflation rate in the United States has increased from 3.2% in 2011 to 8.3% in 2022. This means that the purchasing power of the US dollar has weakened in recent years. The purchasing power is the extent to which a person has available funds to make purchases. According to the data published by the International Monetary Fund, The U.S. Consumer Price Index, CPI, was about 258.84 in 2020 and is forecasted to grow up to 325.6 by 2027, compared to the base period from 1982 to 1984. He also anticipates uranium prices to surge much higher, marked by greater revenue predictability and market stability. According to the latest research from Global X, spot uranium prices have leapt 47% year-to-date, amid a host of favorable supply and demand dynamics. The uranium price is now up 125% since the end of 2020. Let's get back to the interview.
I have a very different view of what constitutes real inflation. When I construct a model of the deterioration of my own purchasing power in U.S. dollar terms, I do it including tax. The CPI, which is the index that most people look at, doesn't include tax. So when people look at the CPI and they see a 3.2 number, they think that their purchasing power is getting destroyed to the extent of 3.2% compounded. Against that, 4.7 looks okay. You're making a point and a half. I believe that the purchasing power of my U.S. dollars, and I'm an old fat guy, I don't buy much, is deteriorating at 7%. So for me, if I buy the 10-year Treasury at 4.7, I'm absolutely positively guaranteed a loss of 2.3 a year. If people say to me that they're buying the 10-year for capital gain because they think there's going to be an interest rate pivot and that bond yields are going to decrease, making the price is going to go up, I say, okay, but I'm not a bond speculator. I buy bonds for income. I outcompete other speculators when I speculate. And when I speculate, I don't want a 20% capital gain in a 10-year bond taking illogical interest rate risk. I want an 800 or 1,000% gain in an exploration stock where I figured out the outcome faster than the market. That market is irrelevant to me because I don't invest or speculate in the bond market. To me, from a fundamental basis, it looks like a guarantee of no return. And we said at the time, there was two things that were going to happen. One, Sprott had used up a bunch of the available pounds for sale in the Spot Physical Uranium Trust, and that over time, that the fact that the above-ground inventory had disappeared was going to occur to the whole market. The second change was going to be the pace of Japanese restarts. I said to you, and I said to many others, when the Japanese began the process of restarting their reactor fleet, that demand for increase would supply, but the available inventory held for sale would disappear. And that's precisely what happened. I didn't know when it was going to occur, which I told you at the time. I said, this is going to happen. I can't tell you when. This is inevitable. It may or may not be imminent. It turned out that it happened in calendar 2023, and the market has reacted. What's more important, I think, than the fact that the uranium price has gone from $40 to $75 is that the market transactions have gone from the spot market, which was then 85% of the total market, to the term market, which is now 75% of the total market. What that means is that the uranium industry has gone from being a price taker, taking whatever price was available on the day, to having guaranteed revenues in the 5-month time frame, 5-year time frame, 7-year time frame, even 15-year time frame. That means that when Cameco or Kazatomprom now return mothballed pounds to production, they know what the revenue line is going to look like for 15 years. There's a certainty around margins. And that makes a huge difference.
Government and industrial demand for gold will also factor into where prices head, but overall, experts say prices are likely going to rise in 2024 and then hold steady from there. The latest developments in the gold market signal a resurgence of interest in this precious metal. What are your thoughts on gold as an investment or safe haven asset in the current economic climate? Do you believe that gold's recent performance will drive it towards new all-time highs? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.